Welcome back, everyone. This is David George. Today, we need to seriously talk about this because what's happening right now in the markets, it's getting out of control. I'm talking about what might be the biggest financial illusion of our time, the index fund bubble. For years, people online have been whispering about this. Index funds are in a bubble. Everyone's buying them blindly. No one cares about what's inside. And you know what? There's some truth to that. People have been told that index funds are good and stock picking is bad, full stop. So now, investors are piling in without even looking under the hood. And the result? Prices are soaring. Not because they're suddenly minting more money, but because everyone's buying the same baskets of stocks over and over again. And if that sounds confusing, don't worry. We're going to break this down in plain English. The question now, is it time to bail out of those tech-heavy index ETFs like VOO or SPY that have ballooned to record highs? The answer can be found with Michael Burry. Yes, that Michael Burry, the one played by Christian Bale in The Big Short. And by the way, let me know in the comments below if you've seen The Big Short, and don't forget to click like and subscribe. It helps with the algorithm. Now back to Michael Burry. He isn't just talking, he's betting big. In his latest 13F filing, Sion Asset Management revealed two massive put option positions that send shockwaves through the financial world. One is a 1 million equivalent bet against Nvidia, worth about 186.6 million, and the other, a staggering 5 million equivalent short against Palantir Technologies, valued at roughly 912 million. Together, they form a billion-dollar wager that the AI-fueled tech boom is about to come crashing down, and so will index ETFs. To most investors, Nvidia and Palantir are the golden children of a new digital era. But to Burry, they might just be the canaries in the coal mine, signs that investors have lost touch with reality, chasing momentum rather than value. And when Burry bets, the whole world pays attention. The last time he made a move this bold, the global economy fell to its knees. Now let's rewind to 2019. Michael Burry went public saying index funds are the next big bubble. He claimed their prices had detached from reality, much like the housing did before the 2008 crash. And back then, most people laughed it off. But now, it's 2025. We've had 6 more years of data, and it's time to ask the uncomfortable question, was Michael Burry right? Remember the subprime mortgage housing crisis? Banks were handing out loans to anyone who could fog a mirror. Oh, you made $1,200 a month? Sure, here's $400,000 for a house. Those risky loans were then bundled and sold as safe investments. When the borrowers couldn't pay back, the whole system collapsed. Now Burry says the same pattern is forming, but this time it's not mortgages, it's index funds. And here's the thing, index funds work. They're cheap, diversified, and simple. You don't need to spend 12 hours a day analyzing stocks. And historically, they've beaten most of the active fund managers. That's why everyone from your coworker to your cousin's financial advisor keeps repeating the same mantra. Don't try to beat the market, just buy the market. And for the most part, that advice has been gold. But here's the catch, and it's a big one. Here's where things get weird. When everyone buys the same 500 stocks, not because they believe in them, but because that's what the index holds, prices start to drift from reality. Stocks stop being valued on what they're worth and start being valued on how much money is flowing into index funds. And because of how the S&P 500 is structured, nearly 40% of every dollar now goes into just 7 companies, most of them tied to AI. That's the highest concentration in history. So when you think you're diversified, you're really just buying more Microsoft, Apple, and Nvidia. AI has been incredible. Let's be honest. It's revolutionizing everything, from research to investing. But here's the concern. Many of these companies are valued for perfection, as if profits will keep doubling forever. And the truth? Some of these businesses aren't even profitable. They're eerily similar to what we saw in the dot-com boom. Investors then were saying, this time it's different. Spoiler, it wasn't. Now, Look at Palantir, which has a price-to-earnings ratio of 442, and Vanguard Index Funds, which holds about 9.08% of Palantir. Other index funds are doing the same thing. Is this a repeat of the dot-com bust? And here's where things could really get off the rails, because we're now seeing record amounts of people leveraging and borrowing and buying 2 times and 3 times leveraged ETFs, convinced the market will always go up. Sure, when stocks rise, those funds double your gains. But when markets drop 10%, you lose 20% or sometimes more. If too many people are using leverage and the market stumbles, margin calls will hit. Liquidations will snowball, and we'll see a cascade of forced selling. Sound familiar? It should. That's how bubbles pop. Now, everyone loves index funds. The S&P 500 has become the default investment for millions of people. Plug in your money into Vanguard's VOO and forget about it. And boom, you're diversified, right? Well, not exactly, because lately the S&P 500 has stopped being a reflection of the entire US economy and started behaving like a handful of overpriced tech stocks glued together. Meanwhile, there's one company that's quietly avoiding the hype, compounding the wealth the old-fashioned way, Berkshire Hathaway. Let's start with the uncomfortable truth. The S&P 500 isn't really 500 equal companies anymore. Today, the top 7 stocks, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, make up roughly 40% of the entire index. That means when you buy the market through VOO or SPY, almost half your money is going straight into a tiny basket of mega cap stock names, many of which trade at nosebleed valuations. Sure, they made investors rich in the short term, but history tells us that when too much money crowds into a few names, the ride eventually ends. It's the same story every time. Investors pile into what's hot and forget about the fundamentals and start calling it diversification. That's not investing, that's momentum chasing with a 401k. Now, contrast that with Berkshire Hathaway. Warren Buffett's empire of businesses run with one goal in mind: buy wonderful companies at a fair price and hold on to them forever. Unlike the S&P 500, Berkshire isn't forced to buy expensive stocks just because they're big. Buffett and his team buy when they see value, and they hold when others panic. When Apple trades at 40 times earnings, Berkshire trims. When the market melts down, Berkshire deploys its $380 billion cash pile into bargains. That's the key difference. The S&P 500 is programmed. Berkshire is thoughtful. When you buy Berkshire Hathaway, you're not just buying a stock. You're buying a collection of businesses, and not the kind that rely on hype or quarterly AI buzzwords. You're buying Geico, the insurance company powerhouse that funds all those float profits Buffett reinvests. BNSF Railway, one of America's largest freight railroads. Berkshire Energy, a major player in renewable and utility infrastructure. Precision Cast Parts, Dairy Queen, See's Candies, Fruit of the Loom, and dozens more cash-generating companies. And then there's that $370 billion equity portfolio built on timeless businesses like Coca-Cola, American Express, and yes, Apple. But at prices that make sense. This isn't speculation, it's ownership of the real economy. Right now, the market loves shiny things: AI, cloud computing, data analytics. But let's be honest, many of these companies don't generate consistent profits, and some, like Palantir, trade on dreams rather than earnings. Meanwhile, Berkshire just keeps printing free cash flow quarter after quarter. It doesn't chase hype, it lets hype come to it. Buffett and Munger built their empire by waiting for mispriced opportunities. When fear returns, and it always does, Berkshire's cash pile becomes a weapon. That's when they buy the world's best companies at discounts the S&P 500 can't even recognize. Michael Burry once said index funds were becoming the next bubble because people were buying them blindly, without caring what was inside. Buffett hasn't used those words, but he's quietly been preparing for that exact scenario. He's been selling stocks when others buy. He's been hoarding cash while everyone else leverages up. He's been buying back Berkshire shares, signaling that the best deal in the market might be his own company. That's classic Buffett. While everyone's chasing yield, he's building optionality. And if you think about it, Berkshire Hathaway is its own kind of index, but instead of being run by an algorithm, it's run by some of the smartest value investors on the planet. It's diversified across energy, insurance, transportation, manufacturing, finance, and consumer goods. It adjusts to opportunities as they appear without a rebalancing formula forcing them to buy overpriced stocks. It compounds book value, not just price charts. In other words, Berkshire behaves like an active version of the US economy, one that doesn't pay 40 times earnings for hype. Since 1965, Berkshire's compounded annual return is around 19.8% versus about 10% for the S&P 500. That's not just luck, that's decades of discipline. Even today, during one of the most overvalued market cycles in history, Berkshire continues to outperform during downturns and protect capital when tech-heavy funds stumble. It's the perfect example of why fundamentals still matter. Bottom line, index funds like VOO are great for people who don't want to think about investing. They're simple, they're automated, and they've worked beautifully during bull markets. But here's the catch. The higher those tech valuations climb, the more fragile that simplicity becomes. Meanwhile, Berkshire Hathaway sits patiently, cash-rich, and ready, run by value investors who've seen this movie before. So while everyone else is crowding into the same 7 names, I'm parking more of my portfolio where real capital allocators live. Because when the hype cycle ends, and it will end, I'd rather own the investor buying the bargains than the index buying the bubble. And if you haven't done so already, don't forget to click like and subscribe and leave a comment below if you've seen The Big Short or agree with Michael Burry that we're an index bubble or hold Berkshire Hathaway stock yourself. Thanks for watching, and I will see you in the next video.